Decades, people have drawn comparisons between gambling and trading, but in 2025, that line has nearly disappeared. The language, the rush, even the culture, they've all started to merge. Casinos have apps, trading platforms have confetti, and the same dopamine circuits that once fired over slot machines now light up over candlestick charts. The difference? One gets called a vice, and the other gets called financial independence. Let's start with the psychology. Both gambling and short term trading rely on what's called variable reward schedules, the same mechanism that makes slot machines addictive. You take a risk, you wait for a result, and the outcome is unpredictable. That uncertainty releases dopamine, a chemical that keeps your brain craving the next hit or the next win. The market is just a more sophisticated casino. Instead of spinning reels, you're watching red and green candles. Instead of betting on cards, you're betting on volatility. And because trading has the illusion of being analytical, people often mistake compulsion for discipline. And studies back this up. A 2024 paper published in Frontiers in Psychiatry found that people who trade frequently score significantly higher on problem gambling assessments. The same psychological scales used in addiction studies. Another study in Addictive Behaviors found that over 90% of day traders also gamble, and roughly 1 in 13 meet the full criteria for a gambling disorder. So when people say trading can feel like gambling, it's not a metaphor. Neurologically, it's the exact same loop. Now we're watching a new layer of this addiction emerge, the streamer effect. Finance creators are live streaming their trades, turning speculation into entertainment. They'll flip $500 into $10,000 in a single day, scream into the camera, and tell you it's easy money. What they don't show are the weeks where they lose it all. They glorify leverage and options like it's a game, but it's really not. When you trade options, you're not just buying a ticket to profit. You're entering a contract with an expiration date. And if that contract expires out of the money, it's worthless. And if you're selling options and the market moves against you, you can be on the hook for thousands of dollars you don't have. It's the equivalent of going all in at the poker table, except you're borrowing the chips. The problem is the people watching these streams don't understand the math, the margin requirements, or the downside risk. They just see the dopamine, that winning moment, and they chase it. What's interesting is that this isn't just a theory anymore, it's showing up in the data. According to the Wall Street Journal, Gamblers Anonymous meetings across the US are now seeing more people showing up because of day trading. Not blackjack, not sports betting, not slots, trading. One man in a Manhattan meeting described options trading as the crack cocaine of the markets. Clinics that once treated casino gamblers are now reporting that around 10% of their patients are seeking help specifically for trading or crypto addiction, a number that was nearly zero before 2020. Researchers have even coined a new term for it, problematic trading behavior. A 2023 study out of the University of Helsinki found that compulsive traders displayed almost identical symptoms to pathological gamblers: preoccupation, loss of control, chasing losses, and financial devastation. In a Dutch study, about 4.4% of retail investors were classified as compulsive. Not just impulsive or emotional, but clinically compulsive, meaning they continued trading despite the consequences. Those numbers might sound small, but when you realize there are tens of millions of active retail traders globally, that's hundreds of thousands of people silently developing what's essentially a trading addiction. Here's where the psychology gets dangerous. In gambling, there's something called loss chasing. When you lose, your brain doesn't register it as over. It sees it as unfinished business. So you double down, you bet bigger, and you tell yourself you're just trying to get back to even. Day traders do this constantly. They just call it averaging down or re-entering the trade. But what's actually happening is emotional deregulation. You're not managing a portfolio anymore, you're managing withdrawal. And I've heard people say things like, I'm not gambling, I'm analyzing. But that's what every gambler says before placing the next bet. The scary part is that modern trading apps make it seamless. You can lose thousands of dollars in minutes without ever leaving your couch. There's no casino pit boss, no bouncer, no physical cash to hand over, just taps, swipes, and another rush of dopamine. We've turned risk into a personality. People live stream their losses for entertainment. Reddit calls it degeneracy, like it's a badge of honor. TikTok glorifies the high-risk trade, and the system profits off the churn, not whether anyone actually wins. The house isn't the casino anymore. It's the broker, it's the algorithm, it's the platform that gets paid every time you click buy or sell, whether you win or lose. Now, day trading isn't evil. It can teach discipline. It can absolutely build wealth if done responsibly. But pretending it's not psychologically addictive is naive. When you start seeing people who once called themselves investors walking into a Gamblers Anonymous meeting, that's not a coincidence, it's a warning sign. And at some point, we have to stop asking, is trading the new gambling, and start asking, why does it feel so familiar? Because for a growing number of people, the difference between the casino and the market is just the dress code.